Hi, everyone, and welcome back to the Weekly Rebalance. Excited to have you here with us for this episode today. Our research of the week, we're going to focus on REITs and maybe focus in on some subsegments of that, or some segments of that market in specific, and just talk about that since we've gotten some advisor interest in that topic here recently. Ethan, how you doing?
Doing pretty well, Nick. Thanks. Good to see you.
Yeah, good to catch
Excited,
up.
excited to see what we got going on here. And it's a timely episode because we've got some crazy stuff going on in the Treasury market, and with yields going all over the place, rising, going higher and higher, which definitely affects REITs quite a bit. So
Yeah,
timely episode here. Not
definitely.
actually planned, I don't think.
No, no, not
Yeah.
at all.
So yeah, well, you want to catch us up on markets and especially on what's been going on in treasury markets recently with the yield spiking?
Yeah, yeah, absolutely. I don't have that chart pulled up. I know you had that one on that call we were on earlier today. I can pull up a yield curve change chart. It just might take me a minute. But in terms of
Yeah, I've got it.
treasuries, okay, perfect. Yeah, in terms of treasuries, we're seeing long-term yields going up quite a notable amount in the past month or so. Um, Borrowing costs going up further along the curve, which I think ties to our conversation last week about Warsh coming into the Fed, in addition to increased inflation expectations. As inflation expectations increase, we see long-term yields tend to increase as well to compensate investors for having a fixed rate of return for whatever amount of time they lock that in for. And then in addition to that, inflation uncertainty, since we're not quite sure where things are going. But also, I think, I think it has an interesting tie-in to what we were talking about last week and Warsh's opinion of the Fed having such a large balance sheet and potentially scaling back some of the QE purchasing or even further. I guess you could say QT, although I think that the real goal is just to shrink the balance sheet, but potentially the Fed getting out of the longer term segment of the debt market potentially could be pushing that up as well. But as you can see here, a notable change in yields across the curve, mainly further out.
Yeah, absolutely. This is creating turmoil in equity markets as well. Nothing too crazy, right? We're in a situation where we're still near all-time highs, but it's certainly creating some volatility and some churn as well.
Yes, yes, definitely. And like you said, it's going to tie into our conversation about REITs later with the financing rates.
Yes, absolutely. And we still struggling with crude oil. It's
Yep.
not that Iran war premium has not gone away, and we've got some struggles to deal with there. So, hopefully this can all resolve itself. Again, the S&P is hovering near its all-time highs, and so
Yeah.
is the Dow. So are most indices like the Nasdaq as well. But there's now that we're getting past earnings season, we're in a situation where some of this comes back into focus. I think there was a lot of exuberance around earnings season and what was really a phenomenal earnings season, but some of these other things are now coming back into attention while we have a break from focusing on earnings.
Definitely. I mean, we've seen that the past couple of days, the market moderating a notable amount. I mean, two relatively negative days here coming off of a winning streak for a period of time. So uh, definitely something to keep an eye on.
Yeah, absolutely. Well, data center REITs, the research
Yeah.
of the week. So
Yeah.
I mean, the big picture is we've got this. I mean, they're the obvious physical backbone of this AI revolution, but they haven't performed like the hyperscalers of NVIDIA and Microsoft and all these others. But they're the beneficiaries of a lot of spending. I think in 2026, the expectation is $430 billion in CapEx infrastructure spend from just the Mag 7 alone. So
Yeah.
lots of capital flowing that direction, but they've lagged compared to the Mag 7 and these hyperscalers like NVIDIA.
Yeah. They certainly have. I mean, still, when you compare them to the broader market, REITs in general have just performed relatively well over the past 25, 50 years. Just not even just focusing in on data center REITs. Again, that's a more modern segment of the market, but just REITs in general have performed pretty well. But as you mentioned, I mean, it's certainly not the same returns that we've seen from those Mag 7 stocks over the past 10 years.
Yeah, yeah, absolutely. Not the same, not the same at all. But yeah, there are some really the like you mentioned, one of the subsets of this is data center REITs. You've also got the tower REITs, data center REITs, some examples, Equinix, Digital Realty Trust, Iron Mountain, your tower REITs, the classic American Tower, Crown Castle are two of your strongest players there. But they're also very interest rate sensitive. They typically have pretty heavy debt loads, and that oftentimes are valued partially as yield instruments in cases like what we're looking at now, where yields, especially longer term yields, have risen a lot. That, it's almost like a bond, yields up, prices down, and that's, certainly a risk in the data center REIT and the tower REITs, any type of REIT, because of the typically heavy debt loads. But there's this tension building between, great operations and lots of spending coming their way and a rising cost of capital because they have to build out a lot of infrastructure. And a lot of that's being financed with debt that is becoming increasingly more expensive.
Yeah, and maybe not really sure what the overall experience of the people listening, just in case we have anyone new here. Maybe it would be helpful for us to kind of talk about just the structure of a REIT and why they can be so debt dependent. You know, just based on the structure. And ultimately, it comes down to they can't really hold on to the earnings that they make. They have to distribute at least 90% of the income that comes in out to their shareholders. Otherwise, they'll have double taxation, which means worse returns for the end investor, but also they have to pay taxes as well. So they can't hold on to the income that they're generating to invest in other products or other locations. So the build out or additional acquisitions, things like that, either have to be funded by new equity or debt. And commonly, especially over the past 10 years, it's debt.
Yes. Yeah. Perfect example would be Equinix. They have, this huge CapEx spend, and it actually exceeds their operating cash flow from 2025. And they actually ran a negative operating cash flow in 2025, even though their stock actually did pretty well recently, or during good portion of this period. But they have this issue there, like you said, they're paying out their earnings, so they don't build up cash. So if they want to, there's nothing they can do but take on debt, which can actually, their CapEx in a year could actually exceed their operating cash flow just because of that issue.
Yeah. Yeah. Easy to happen, especially with capital intensive build outs like data centers.
Yeah. Yeah, exactly.
Yeah, for sure. For
So
sure.
what are your thoughts on the two different types? We've got the tower REITs and the data centers. What's your thoughts on we covered data centers? They're so new and covered. I feel like it's obvious what's happening there. What's your thoughts on the tower REITs? And some of them are involved in data centers as well.
Yeah, yeah, they've certainly been trying to diversify a number of them. Yeah, I think it's interesting. I mean, one of them is much more, I would say, mature than the other. Much more established. We kind of know that the towers are going to be there in place. We have an idea of what the demand is, how that's going to grow in the future. With the data centers, I think the remaining question that we'll have to see is, does this CapEx continue at the rate that it's going right now? And I think we'll get an insight into that with NVIDIA earnings tomorrow, potentially. Get a little bit more insight into that. But how much infrastructure do we really need on this data center side of things? I mean, in addition to that, there's growing criticisms by the public of building these data centers because they're loud, they're noisy, they drive up energy prices in
Yes.
the area, they consume a lot of water, they can contaminate the area. So there's some valid concerns and potentially some issues with building these things out in the future. So there's a lot more unknown, a lot more unknowns in the data center side of things as opposed to the tower industry. That being said, data centers are the exciting thing right now. There's obviously tons of growth headed that way. CapEx continues to be very impressive. It's clear that there's going to be a lot of demand for that. Uh, but we're still in the build out phase. It takes about 18 to 24 months for these projects to come online. Um, so we're kind of behind the curve here, and we'll just see where things end up. How many of these data centers do we actually need? Uh, Things like that. I don't know. That was a really broad answer. That was not the greatest
No, I
answer.
think that it answers it though, because the problem is there's some unknowns, right? So we're expecting $430 billion of spending from just the Mag 7 on infrastructures like data center REITs in 2026. Now that's expected to almost triple by 2029 in almost 3 years. And then are we going to have this classic overshoot where
Yeah,
we overinvest and then run into issues with a bunch of empty infrastructure? But and that's especially scary when you're looking at heavy debt loads. However, the upside on these data center REITs is phenomenal, right? Like if all of that pans out and potentially even accelerates beyond what we're expecting, then these are great beneficiaries of this focused CapEx spending from the Mag 7, but really any player that is growing their AI infrastructure, because it takes a lot of data to manage these models and to process these models. So
certainly.
lots to there is a massive bull case and there is a bear case as well.
Yeah, and I think there's some interesting parallels. Again, overall, I'm pretty bullish on the whole data center REIT side of things. I think there's just a lot of momentum in that space. I think we're going to continue building that out. It's one of those things that I think is coming. But I think there's some interesting parallels in the past, even in the REIT space, just with maybe overshooting, getting a little bit excited, getting ahead of ourselves, and certain players in the space suffering for it. I mean, Crown Castle
Yes.
had their fiber incident, basically where they were putting a lot of equipment on traffic lights, things like that, and it just didn't pan out the way they expected. They ended up writing
Yes.
off a tremendous loss on it. Similar story with, I think in the early 2000s, late 90s, when they were laying all the fiber optic wire for internet usage, and it was a little bit earlier on. I don't think this was specifically a REIT company, and I can't think of the name of who it was in specific, but basically they laid a ton of fiber optic wire for the network, and they were just a little bit early to the party. Obviously, all of that stuff is being used today and is very beneficial, but at the time, they were just a little bit early and invested a lot upfront and ended up losing out. So that's kind of the warning that we can take away from the past, maybe to be just temper our expectations a little bit. But overall, I think there's a lot of bullish factors for data center REITs.
Yeah, totally agree. And towers as well.
Yeah.
Um, we've got some bullish potential for towers as well. There's 5G being built out. Lots of there's bullish case for both. Obviously data centers are the most exciting though.
Oh yeah. But yeah, you're 100% right. Lots of excitement on the tower side of things as well.
Yeah.
I think that's interesting too, because the additional investment for improving the tower networks is not nearly as high as what we see for a data center where they're having to build out everything brand new. From what I understand, the cost of making a tower, able to provide 5G as opposed to 4G is a relatively minimal investment. So yeah, just two different sides of the coin there in the REIT
Yeah.
space.
Yeah, absolutely. Very interesting. An interesting space at the moment.
Yeah, yeah, but I mean, people have been compensated to be to be in there for a while. I've got a chart here. Let me go ahead and generate this as a PDF really quickly. Basically, it's the total return of Equinix and DLR, or Digital Realty Trust, compared to the S&P 500 over the past 25 years, and it's impressive.
Yeah, let's see it.
Here we go. It was All right, so here we are. This is total returns. Uh, going
Wow.
back to, yeah, it's really impressive. That's for sure. I think going back to about 2002 when I think Equinix or DLR was founded at that point or listed at that point. But you can see pretty impressive returns from both of them. Kind of in a similar space, they play the area in different ways. Um, but very impressive performance compared to the S&P 500. And it's worth noting as well that a lot of this performance is going to come from distributions from the fund, making comparing total return levels very important as opposed to just price return
Yeah.
in these cases.
Yeah. No, that makes sense. Yeah. Great chart. Thanks, Nick. That's a good visual representation of what's going on here. And the recent years have also been great too, as this spending has ramped up even more.
Yeah, no joke, no joke. I mean, REITs as a whole have provided good returns for investors over time. I think they get kind of a bad rap potentially. There's certain segments of the market that potentially harm the reputation of REITs because people
Right.
get bad experience. Uh, Particularly some of the private ones, people have had bad experiences with those, having their capital locked up for an extended period of time, things like that. Uh, Potentially kind of create a little bit of a negative stigma around REITs, at least for certain individuals. But
Yeah, exactly. That's a good thing to highlight here is for, a lot of our listeners will understand this already, but there's a lot of vast differences in the way that you can invest in a REIT. You've got and the vast differences in the key thing I'm thinking of is liquidity. You've got the liquid American Tower, that's a publicly Crown Castle, Digital Realty that are liquid REITs that you can buy and sell intraday. Totally different than some private REIT that is totally illiquid for a long period of time. Even if, and a lot of investors can get inadvertently tricked into having the issue of, thinking that they're more liquid than they really are, or they're going to pay these dividends at a higher rate than they really are. And it's very tricky, especially when they're so interest rate sensitive, and they have to take on oftentimes pretty heavy loads of debt. And the terms that seem like great terms at the beginning, especially in the illiquid space, can be very altered by changing interest rate environments and all of that stuff. And if an investor is not aware of all the risks there, that can be a very frustrating situation to be in.
yeah, yeah, it certainly is. I think we talked to a decent amount of people who have had a bad experience with one or another private REIT having capital locked up for a long period of time, and it's easy to sour on the whole space after an experience like that. But like you mentioned, there's definitely some good ones out there and some meaningful exposure to get for diversification purposes.
Yeah, absolutely. What would be your preference, Nick? Like, I mean, maybe this isn't unanswerable question, but for the average investor, go public, private? Is there an illiquidity premium or risk premium that's associated with private REITs? Or would you just say, yeah, you can get that exposure publicly? I mean, some would argue like a company like McDonald's is a REIT with all their real
Yeah.
estate exposure, but although it's not. But what's your thought on that?
Yeah, I think it's tough. My personal take, you should get a liquidity premium for anytime you take on anything private. It's just there's a lot of hurdles to that. Most of the time, you've got to be an accredited investor, meet certain minimums. You got to buy a certain amount of it, and your capital is locked up for an extended period of time. I find it hard and again, I'm not an expert in the private REIT space, so there's probably some great products out there that I'm not aware of that are really good. But I just feel like there's a lot of great options in the public space. We've been talking about Equinix, other names like that that provide exposure to the REIT type that you're interested in. for the most part. So I think there's just a lot of good public options. Again, I don't think we're not specifically going out and recommending any one of these. I just think that there's a lot of good options out there in the public space, and I have a hard time justifying all the hurdles you've got to jump through and the restrictions that you face if you go private.
Yeah, no, it's definitely something to be aware of, and there are certain investors that are willing to take that risk, and that's in fact the right risk for them to take. But yeah, for a lot of average investors, that you can get a similar concept in public markets, which is and a lot don't even realize that they feel like they're priced out of the REIT market, or they don't have enough assets to get into the REIT market, or whatever the case may be. But that's not necessarily true. You've got some really good public options. The other thing that I was thinking as we were talking through this is most people have so much equity and exposure to real estate in their home anyways, that it's an important thing to weigh, that when you are investing in a REIT, that you are increasing your real estate exposure. If you have a mortgage, you also have interest rate sensitivity. You're on kind of on the opposite end of that, I guess, or well, not really. You have, but my point being is that you have a lot of this exposure. It's different. It's definitely different than your home, your home equity and your mortgage and your real estate exposure there. But it's important not to get over leveraged there, because that's an issue that I think happens a lot in the real estate space, is over leverage, both equity and home being very low, and then not realizing that adding a significant real estate REIT exposure is also increasing your equity inadvertently, or your leverage inadvertently. So something to be very aware of as you make those allocations. If you have too meaningful of an allocation, you end up with some potential risk that you don't even realize you've taken.
Yeah, that is a great point. Definitely something important to note, especially for the accredited investors who are typically able to access those more private, illiquid real estate options. It's kind of interesting. Those people also tend to be more likely to own a house as well, so probably have more meaningful real estate exposure as a part of their overall portfolio as well. So that is an interesting little thing.
Yeah, for sure. So, well, all good things to take into account. What else do you have on data centers and REITs and tower REITs? What else kind of research did you find this week?
I don't really have much else. Just like a broader view of the space. We've gotten some questions about REITs in general here recently. I think there's a lot of excitement about data center REITs, tower REITs right now. Just thought it would be an interesting topic to cover. I don't really have anything else too specific. Main thing, the main specific thing I wanted to cover was, the potential bearish case for them, and highlight the example that we had from Crown Castle a while ago. But
yeah, absolutely. Same here. I don't have too much else, so I think we covered it pretty well. And maybe we can do a couple trivia questions, and then close it up for the week.
I like it.
You let me see. Let me looking at my questions for you here. Do you have? I might only have one good one.
That's okay. That's all right.
Yeah.
I can go first if you want.
You go ahead and go first, Nick. Let me get my thoughts together.
Yeah, all good. Let's see here. We'll go with this one. REITs were created by an act of Congress in what decade?
I'm gonna guess. Okay, the 60s.
Yeah, you got it. You got
Yes.
it.
I know they've been around for a while. I was gonna guess either 60s or 70s, but what was the actual year?
1960, it looks like. Signed into law by Eisenhower in 1960.
Okay, nice. Very good. Cool.
Yeah.
Good question. All right. I've got a let's see. Okay, I got two decent ones. You want just a regular market trivia question that's kind of AI chip company, or do you want a REIT specific question?
Ooh, let's go REIT specific. I'm not going to get it, but let's do REIT specific.
Okay. Which REIT, better known for storing paper records in warehouses, quietly posted the fastest revenue growth among all data center peers in Q4 2025.
I have no idea. It's
We
paper
mentioned it
storage.
earlier.
We
We
mentioned
mentioned
it
it.
earlier. Oh my
I think
goodness.
I think I did.
I'm trying to think. Most of the ones that I know about, somewhat technology related.
Yeah. It's not, it's not EQIX or DLR. And
Yeah,
obviously it's
I
not digital
figured
realty.
that. Figured that.
Yeah.
Shoot, I don't know. Maybe I don't know. The other one that's coming to mind is Realty Income Corp, right? Ticker O.
Oh yeah. Yeah.
I doubt
It's
it's
not,
them, but
it's not that. You're gonna go look up this company afterwards, but it's
yeah.
Iron Mountain. The ticker symbol is
Oh,
IRM, and they
okay.
had a 16.6 year-over-year growth in
Wow.
2024. Oh,
Yeah,
Q4 2025, sorry.
did not know that. Okay, Iron Mountain.
Yeah. So not
Wow.
specific investment advice, but that was just some trivia there about that.
Yeah, yeah. I like that one. I didn't realize that that was such a big thing.
Yeah, absolutely.
All right. I've got another one. This one's open-ended, but I think that we wrap things up a little bit shorter on our research side of things, so maybe it's a good conversation starter for a little bit.
Yeah.
Uh, let's see here. Self-storage REITs have been the single best performing REIT subcategory since 1994, delivering a 15.9% average annualized return. What counterintuitive economic characteristic makes self-storage uniquely resilient, performing both well in booms and busts?
Hmm.
This is more of like an American consumer question. I think it's just kind of
Yeah.
an interesting, like,
Interesting. I'm not sure where you're going with that. What's
yeah,
the
it's not laid out the best. It really, what it comes down to in a boom cycle, when the economy is performing really well, Americans, the consumer, consume a lot and they buy a bunch of stuff and they got to go find a spot to put it. So self-storage obviously benefits from that.
yes.
On the other hand, when we're in a bust, when the economy's not doing so well, people can have to downsize their homes, potentially go to renting instead. And with
Hmm.
that, they've got all of this stuff that they have consumed in the good period that they have to find a spot for.
Yes.
So it tends to perform well in both cycles, which I think that's a really interesting little piece. I haven't like looked into the self-storage REIT space all that much, but
Yeah,
that's a neat little attribute that it has.
absolutely. Yeah, I never thought that's interesting. I'd obviously, you know, I've even used self-storage before. It's a
Like a
common
good
thing.
American consumer.
Yes, that's right. I feel like most have, but
Yeah,
yeah, that's a good point. They would have a potential bull case in either type of a scenario, an economic upturn or an economic downturn.
yeah,
Very interesting. Yeah. Good
yeah.
points. I like that.
Neat stuff. I mean, they pop up all over the place. I feel
Yeah.
like, especially growing up, like I just noticed there were so many
Yeah.
self-storage facilities that got put up. I
People
was like, where
buying
is all this
stuff and they
stuff
don't have
coming
room
from?
for it.
I mean, I totally get it. You run into a need for it, for sure, just as
Yeah.
life goes on. But like, it's crazy.
Yeah. And it's a small enough per month rental agreement usually where it's like, I can swing that. I can do
Yeah,
that to keep
forget
this
that you have
stuff.
it.
Yeah, but instead of going through and getting rid of your stuff, which, maybe we should all do some more of.
Yeah. Well, gotta fuel the economy somehow.
That's right. Keep spending, right?
Keep
Spend away.
spending. Yeah. Guys, I have an idea. We can avoid a recession if we just keep on spending. We just gotta do our part,
Yep, that's right. Everyone do your
max out
part.
that credit card bill.
Don't worry about it. You're supporting the economy.
Don't don't worry about it. You're doing your job. No,
Yeah.
obviously that's a joke, but
Yeah. Well, I've done my part recently with planning and doing this wedding. So,
I know. Well, that was the big thing. We gotta wrap things up here, but yeah, congratulations. I'm looking forward to coming up to Ohio this weekend on
yep.
your
Thank
wedding.
you. Thank you
And
very much.
yeah, you've got to break it to the listeners that they're not gonna get their weekly dose of Ethan for the next 2 weeks.
Yep, I'm getting married on Saturday and be out for 2 weeks in Hawaii with my new wife Avery. So we'll be I'll miss you guys for 2 weeks, but then we'll be back in beginning of June.
Yep. And don't
Second
you
week of
guys
June.
worry, you're still going to get your weekly rebalance content because I know that you guys need it. We're going to have
Yep.
some guests come in and fill in for Ethan while he's gone. So we'll get some different context here. And then Ethan will get some different context with someone else when I'm out in a little bit after that. So looking forward to all of this.
For sure. Well, thanks, Nick. Thanks everybody for listening, and I'll see you guys back in June.
All right. Thanks, everyone.
Bye bye.